Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Dollar General.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we jump completely into today's deep dive, I want to quickly mention the StockOracle 14-day try.
Oh yeah, the link for that is right down in the description if you want to check it out.
Exactly. And standard affiliate disclosure, we do get a small commission if you sign up through that link. Also, just remember that AI insights and value estimates can be wrong, right?
Yeah, absolutely.
So always verify the numbers yourself. And as always, we are not giving you financial advice today. We're not telling you to buy, sell, or hold. My focus here is purely on capital protection and, long-term wealth building.
Right, and I'm looking at the growth thesis, the long-term compounding potential, which makes Dollar General such a fascinating deep dive today.
It really is. I mean, imagine this massive retail giant, right?
Wow.
Just losing 40% of its value over 5 years, trapped in this awful death spiral of missing earnings, frustrating shareholders, basically left for dead by the market.
Oh, entirely left for dead.
But then suddenly, that exact same stock violently surges 18% in just 13 weeks.
Yeah.
Completely defying all the broader retail gloom. And they did it without opening a single new store or, announcing some flashy new product line.
Which is wild, because it's really rare to see a retail incumbent of this sheer scale show that kind of sudden, violent upside volatility.
Right. So we're drawing our insights today from an equity research report dated August 23, 2026. And the stakes for this wealth-building thesis are incredibly high.
They are, because investors haven't just been selling the stock, they've been actively punishing it. So the big question we're unpacking for you today is this sudden 18% bounce a genuine structural turnaround? Is the underlying engine actually fixed?
Or is it just a classic dead cat bounce before it goes back to, crashing? Because from a capital protection standpoint, I look at this setup and I am extremely cautious.
Understandably so.
Yeah, let's look at the business quality and the fundamentals right now. The stock is currently sitting at $123.41. It's in this really tight consolidation phase.
Right, it crossed above the 50-day moving average?
Yeah, it crossed the 50-day, which is at $120.08, but it's hovering right underneath the 200-day moving average of $123.85.
And that 200-day average is this massive psychological ceiling for Wall Street, a stock that's been battered for 3 years. It doesn't just casually drift above its 200-day trend line.
No, it has to prove it.
Exactly. It has to prove it deserves a higher valuation. Because right now, the market is weighing a historically depressed valuation against a sudden influx of positive execution data.
And when you say depressed, I mean the valuation is in the basement.
It really is.
The price-to-sales ratio is just 0.61. People are paying 61 cents for every dollar of sales this company generates. The trailing PE is 16.92. It's basically a distressed discount for a company with this kind of massive national footprint.
Right. The market has been totally pricing in a worst-case scenario. But then the catalyst hit. The trigger for this whole 18% bounce was the Q1 fiscal year 2026 earnings report.
Right. Management finally gave us hard data.
Yeah, they delivered a confirmed earnings inflection. So in Q1, net income unexpectedly jumped over 13%, hitting $444 million. And that single data point changed the thesis overnight. Wolf Research even raised their price target right after.
But, okay, looking at the long-term growth drivers here, I have to push back on those numbers because the proportions seem totally distorted.
How so?
Well, the report notes that top-line revenue only grew by 3.4%, right?
Right, to about $10.78 billion.
Yeah, so sales barely ticked up at all, yet net income surged 13%. How does a massive discount retailer boost actual profits by 13% when the existing growth engine, the sales, only grew by 3%?
Okay, so this points directly to the most critical long-term driver in this entire turnaround story. It's the margin lever.
Okay.
So the core bear argument against Dollar General, the whole reason the stock got punished, was these deteriorating gross margins that basically caused a 3-year EPS decline. They operate on insanely thin ice.
Yeah, the trailing net margin is what, 3.63%?
Exactly, a microscopic 3.63%, meaning out of $100 a customer spends, Dollar General keeps just $3.63 in pure profit.
Which gives them zero margin for error. Protecting capital in a business with a 3% margin is terrifying. A tiny bump in fuel costs or, a slightly higher theft, and that $3 is just gone.
Totally gone. And that's exactly what was happening to them for 3 years. But in Q1, they reversed it. They expanded their margin by about 65 basis points. So that brings the implied net margin up to roughly 4.1%.
Okay, wait. Let's really unpack this for the listener because 65 basis points, that is less than 1%.
Yeah.
They improved margins by a fraction of a single percent. Why on earth is Wall Street cheering for that? Honestly, it sounds like finding spare change in the couch cushions.
I know it sounds like spare change, but you have to apply it to their immense scale.
Well,
This is textbook operational leverage.
Okay.
Dollar General does almost $43 billion in annual sales. When you're moving that much merchandise on a razor-thin 3.6% margin, adding 65 basis points is a massive lever.
Because the base is so small to begin with.
Exactly. Going from 3.6 to 4.1% mathematically increases total profitability by over 10%. They got a 13% net income surge without building new stores or finding new customers, just by running the existing engine better.
Okay, so then how did they actually do it? Because if they didn't fundamentally change the business, where did that fraction of a percent come from?
Well, it comes down to fixing their execution mode. The report points out that competitors, like Target and Ross stores, they've been doing great in this same environment,
Right.
which tells us Dollar General's struggles were a company-specific problem, not an industry-wide demand problem.
So what was their specific failure?
It was severe internal bottlenecks. The report highlights chronic store understaffing and total supply chain chaos. When you understaff stores, products literally just sit on pallets in the back room.
Or they just clog up the aisles.
Right. And customers can't buy what isn't on the shelf. Plus, that kind of mess leads to huge inventory shrink, which is just the retail word for theft and damaged goods.
So the margin improvement isn't some accounting trick. It's just management finally fixing the supply chain, paying for labor hours, and getting stuff on the shelves to stop the shrink.
Yep, they stop the internal bleeding. And that margin repair is the single biggest earnings driver right now. If they can just hold on to it, EPS growth becomes exponential compared to their slow revenue growth.
Okay, but as someone focused on downside risk, here's my concern. They fixed the internal engine, sure, but what about the external environment? Like, a retailer is only as healthy as its customers' wallets.
That's the macro tug-of-war we're seeing right now.
Because Dollar General does have a really low beta, right? It's like 0.21.
Yeah, extremely low.
Which usually means it's insulated from market volatility. It's a defensive moat. People need, toilet paper and pantry staples even in a recession. But the report says their core budget-conscious shopper is under severe, severe strain right now.
They really are. Between persistent inflation eating away at purchasing power and the recent cuts to SNAP benefits food stamps, the discretionary income of that lowest earning group has basically evaporated.
Right. So we have this paradox. They're a defensive stock, but their legacy low-income customers might be too squeezed by inflation to even afford the basics anymore.
Which leads to a fascinating structural shift in who is actually shopping there. It's all about the trade-down consumer.
Explain that.
So, as inflation crushes household budgets, middle-income shoppers who used to go to traditional grocery stores start trading down to Dollar General just to stretch their paychecks.
Okay, so fresh foot traffic from the middle class, but doesn't that just mask a darker reality? Like, if the middle class trades down to Dollar General, where do the original lower-income shoppers trade down to?
They drop out of the retail ecosystem entirely. They go to food banks. And honestly, that's the exact thesis of the institutional bears right now. They're arguing that the core consumer is too weak and the new trade-down shoppers won't be enough to offset the people dropping out.
But wait, earlier we said Target and Ross are beating estimates and raising outlooks.
Exactly.
So that proves the demand for discount retail is there. If Dollar General can execute, the macro environment will support them.
Spot on. You can't fix the economy, but management can fix their own store aisles.
Okay, let's look at optionality in the emerging engines here. If they fix the operations and margins expand, the next step for compounding shareholder value is usually share buybacks, right?
Oh, absolutely. The research report heavily flags share repurchases as this major medium to long-term catalyst. It's the ultimate reward. They're sitting on $1.35 billion in cash right now.
And I'm going to stop you right there because I am pushing back extremely hard on this buyback narrative.
Okay, let's hear it.
Digging into the cash flow statement, there's a massive red flag. Yes, they have cash in the bank. But Q1 operating cash flow, the actual cash generated by the business, dropped 15.5% year over year.
Down to $716 million.
Yeah, it plummeted. So if your operating cash flow just dropped 15%, dangling the idea of share buybacks feels completely irresponsible. How can you buy back stock if your core business is generating way less cash?
I won't argue with you there. That cash flow wobble is honestly the ugliest part of this entire report. It is the biggest threat to the long-term wealth-building thesis. A drop like that, while net income is rising, usually means heavy working capital investments, like aggressively buying inventory to finally fill those empty shelves. But if that operating cash flow doesn't recover, the buyback optionality is dead on arrival.
The thesis totally falls apart.
Right, which is why the report frames the upside as a blue sky scenario.
Let's define that for the listener.
Yeah, so a blue sky scenario is an optimistic 3 to 5 year outlook. It's what the business could become if management executes flawlessly. I have to be clear, it is highly optimistic. It is not a guaranteed prediction.
Right, we're not predicting this. But what are the actual mechanics of that blue sky case? Like, what is the roadmap to actually compounding wealth here over the next 3 to 5 years?
So it takes 3 distinct victories. First, the near-term catalyst.
Yeah.
That 65 basis points of margin expansion in Q1 cannot be a fluke. They had to prove structural margin retention.
Okay, so the engine keeps running efficiently.
Right. Second, top-line revenue needs stable 3 to 5% growth, meaning they successfully capture those middle-income trade-down shoppers.
And the third victory has to be fixing that massive cash flow wobble.
Precisely. Operating cash flow has to violently rebound back to the fiscal year 2025 baseline, which was around $3.6 billion annually.
Wow, okay.
If they do those 3 things, hold margins, grow revenue slowly, and hit $3.6 billion in cash flow, then they have the ammunition for massive buybacks. And that's when the valuation completely re-rates. That distressed 0.61 price-to-sales multiple will expand significantly.
So that's the long-term catalyst, but obviously we have a massive near-term catalyst staring us right in the face.
Oh, yeah. The moment of truth.
August 27th, 2026, the Q2 earnings report.
That is the ultimate test. It's going to dictate whether Q1 was just a lucky, seasonal inventory fluke or the start of a durable trend.
And the consensus expectations are pretty clear here. The street is looking for an EPS between $2 and $2.01 on revenue of $11.19 billion.
But more importantly, analysts want to see them strongly anchor their full-year guidance at $7.20 to $7.45.
If they miss those numbers, or if they use the consumer macro environment as an excuse to lower guidance, this stock is going right back into its multi-year nosedive.
The bears will take total control again, yeah.
So bringing this all together for our wealth-building verdict, the strongest long-term driver here is clearly the operational leverage, just keeping those margins thick.
Right. And the biggest threat is the cash flow wobble combined with the strain on that low-income consumer.
So what's the rating here?
The report gives it a 7 out of 10. It's a moderate bullish base case, largely driven by how cheap the valuation is, but it is highly, highly dependent on this upcoming August 27th earnings catalyst.
It all comes down to management squeezing profit out of a brutal environment, which actually leaves me with a pretty provocative final thought for you to explore on your own.
Oh, where are you going with this?
Well, think about the core dynamic we just outlined. Dollar General is trying to fix its margins by capturing the spending of households that are being totally crushed by inflation, right?
Yeah, the trade-down effect. It's the beating heart of their business model right now.
Exactly. Their blue sky success basically relies on the middle class becoming so financially tapped out that they have to abandon their normal grocery stores. So is a booming Dollar General actually a massive warning sign for the broader U.S. economy?
Wow. That's a brilliant, kind of unsettling paradox. If their lifeboat is getting crowded, it means the main ship is sinking.
It's the ultimate paradox of defensive investing. Like, you're looking at a stock that might finally be fixing its engine and taking a breath of air, but its success mathematically requires the rest of the consumer economy to be dragged underwater.
It really forces you to ask what kind of economic environment you're actually betting on when you invest in deep discount retail. Are you betting on management execution, or are you just betting on consumer pain?
Exactly. It elevates this whole analysis from just looking at a stock chart to really looking at a mirror reflecting the U.S. consumer. It's definitely something to chew on as we wait for that August 27th print. We'll have to see if they can fix the cash flow and hold those margins, but I think that's going to do it for today's deep dive.
Remember to check out the StockOracle link in the description, and always verify your own data.
Thanks for joining us. We'll see you next time on Smart Wealth with Joshua.